Hey, welcome to the Airmere Trading Group 1 meeting. Today is the 18th of October. Oh, it just got filled. Um, we're looking at a pretty good rally today. We're off from the highs quite a bit. I think we were up like 80, 85 earlier. And you can see I've got SPX on the left and ES on the right. So ES obviously has less gaps, and SPX, you can see it opened up pretty high, went higher, and then now it's come back a bit. If we look on a smaller time frame, say 5 minutes, you can see kind of opened up fairly near the high and then been selling off. I guess we had a lot of earnings stuff going on today. So if you go to airmere.com/SMU, we talked about this in the zero DTE trading we did earlier today, which made money, by the way. So if you scroll down here, close that. We had a bunch of earnings, I guess, last night. It's interesting they changed this. Basically, mega caps are having a strong day today. There was something with the treasury yields ticking down. I think they were talking about the 10-year yield. Let's go back to a daily chart. So they're down a little bit. So normally, here's the dollar. Dollar's kind of treading water. So the currency is measured against the dollar. The euro also kind of treading water, but up slightly. British pound is down, but they've got some financing issues they're dealing with. VIX, let's see, that's a daily chart. Let's go a little bit longer. Let's switch this to a single pane. And let's just see how we're looking here. So this is a big picture. 2020, here's our COVID spike, got up to a high of 85. And we've kind of been in this range, say upper teens to upper 20s, I guess, for a while, kind of in the upper end of that. VIX Central, if you look at the term structure, we're still in backwardation, pretty solid. So still a lot of fear in the market. Interesting, if you look at the, let's do SPX, a daily chart, we've had a couple of days of higher, and then we sell off. Couple of days up, and then we sell off. And here we're going higher, but sell off, I don't know. A lot of people think rallies right now are opportunities to sell. ES is a little bit smoother. So I see Wayne's here. Good morning, Wayne.
Good morning, Tom.
Hey, your microphone sounding spiffy. So
Oh, spiffy now, huh?
yeah.
As long as it's
So
clear and
uh,
clean, that's good.
so I know we had a lot of good earnings coming out, which is kind of propelling the market higher, but I don't know if that's enough to overcome all the other negative news.
There's always some reason the market's got to go up, right?
Well, that's what they say. It climbs the wall of worry, right?
Oh, no, we're falling down the slide of hopium still.
Oh, the hopium, right?
Yeah, there's a lot of hopium still out there. And this is a uniquely interesting bear market. I mean, in 2008, I felt like I mean, in 2008, I was studying finance, but in general, people kind of had fear in general. Like it was like, oh, this is bad, right? Like there
Right.
wasn't this like, oh, this is nothing. We got this. The Fed's gonna turn. It's all gonna go up, right? We're doing just fine, right?
Isn't that when
Um,
Lehman Brothers cashed it in?
right, yeah, exactly. Like it, it's so interesting that that it's just like that. By the way, yeah, Thomas Byron, we're up just a little bit for the year, mostly flat, but I think like up 1 or 2% for the year. And yeah, so it's one of those things that it's very unique that it's been one of those things that I feel like the fear isn't there. So anyways, I mean, for a long only portfolio, or we've been doing fine as far as the sleep well is concerned. I have been in the camp with you. Tom, that you just said there, which is basically every rally I've just shorted the piss out of. But um, and I'm still in that boat, right? It's not good, right? Sometimes I'll throw something in the forum. Like I threw something in the forum, I think right in the beginning of August, where I was like, this is your last chance to get out. It's
Yeah, I
not looking
remember
good,
that.
guys.
Yep.
Yeah. So yeah, I liquidated my wife's 401k at then. Well, I pushed it into a bond ladder because that's all that they offer, right? 401k is very limited. And yeah, I'm pretty much, yeah. I mean, in general, I don't think anyone really cares about my opinion, but in general, it's not looking good out there still. Macroeconomically, we're still contracting. The earnings that are coming out, it's interesting because they're saying that they're good, but they're still down earnings. So it's like, oh yeah, they're beating expectations. And it's like, well, when expectations were horrendous, I guess that's kind of a positive thing if you think about that. So
Right.
I will admit I was pretty surprised with Bank of America's earnings. Did you see those?
I didn't see them exactly, but I saw on that stock market update that they were good.
Yeah, they posted like an 81 per share, and I was wow, like that was pretty surprising. That's actually almost equivalent to what they were prior to the recession so far. So it's pretty cool to see a bank stock doing pretty solidly. If you look into and you kind of dig into where they were getting their earnings from, I haven't dug into details, so don't quote me on anything, but I believe it was a lot from their fixed income trading department. So clearly they've been shorting interest rates or shorting bonds,
Well,
and that's where
the
they've been
banks
making
aren't
their money.
stupid, right? So
Right. Well, and on top of that, the Fed is offering a flat, 3%, I think it's 3.5 or something like that on the reverse repo market. So you can park a bunch of cash right there at the reverse repo and get yield. And so that's what they're doing. It's so yeah, the banking stocks are doing okay. They can, but that's where they're making their money. So they're not making it on, I should say like the general population and stuff. So it'll be interesting once we get into the retailers, where those are at and stuff like that. So yeah, Bank of America is still cruising today too. But I mean, an ironic thing, did anyone notice like or Tom, did you do intraday, right? Did you notice yesterday at the close the kind of oddity in the VIX as it was coming into the close?
let's see. Here's let's do a 5-minute chart. So here is yesterday. So yeah, it was rallying into the close for the last 2 hours.
Right. And what was the market doing at that time?
Let's see. SPX. It looks like it was
Kind of
falling a little bit.
stalling. It was kind
Yeah,
of
it was going
stalling sideways.
sideways to slightly lower. But if you flip
Yeah, I
back to
mean,
VIX, it was kind of going up more than the market was just kind of, I mean, I think I can actually add this, right? VIX and
oh yeah,
SPX.
you can do like a VIX to SPX correlation or something like that.
Yeah, so here you can see VIX is going up and SPX is just going nowhere.
Right. So this is something that I kind of pay attention to, and I don't know if this will help anyone or whatever. But the VIX correlation is a very big deal to me in a lot of my trading. So when I start seeing even intraday, when I start seeing some things that are a little bit odd, which is the VIX going up as the market is either stabilized or even maybe possibly even trending higher, that's normally like my first little like yellow flag. It's like the canary in the coal mine, like, ooh, something's off right now. Like something's not comfortable doing what it's doing. And then if you kind of think about this, we opened up, 1 point, or no, we opened up what, 2.5% this morning? No, it was probably 2%. But anyways, and the VIX was barely down. I mean, look, the VIX is barely down right now with the market up still 1% in a high volatility regime. That is not normal by any means, right? So these are types of things that I kind of look for. Now, granted, I'm totally going to be speaking to my positions because I'm short like crazy right now. But it's just kind of one of those things that it's just a little bit odd. So I'll sit there and I'll find things that'll actually, of course, confirm my biases. So then I'm like, okay, what are things that are long right now? And I'm having a really, really hard time finding something that's a positive to the long side. So, Tom, do you have anything positive to the long side that you can find on a
Positive to the
technical
long.
basis, not like a narrative basis, I should say?
Um, Bitcoin wasn't, or Ethereum wasn't looking too bad, like on a daily chart. It's just kind of going
Oh yeah,
sideways though.
okay, kind of
Um,
stabilizing a little bit.
but I mean, it had a huge sell off here. Like this one bar is down 26%. So this thing
Right.
moves like crazy.
It does. It moves. I mean, that's kind of like oil recently. So I started shorting oil, um, probably I think about a week and a half ago, and I got really surprised by the rally in oil. I mean, that thing really took off in oil, and I mean, it's coming down now, but it's like, whoa, man, that was kind of overblown, honestly. But of course, that's kind of what happens when you've got asset volatility as high as it is right now, right?
Right. Now I gotta get rid of this thing. There we go.
Oh, Marcus says he's got a case for the upside. Marcus, tell
Oh,
us, please. It's good to hear a contradicting uh, point of view.
that's what makes a market, right? Different points of
Please,
view.
yes. Everybody. Nice. So
Well,
you basically think that we're everyone's too short, everyone's too bearish right now, and that'll bounce it, right?
that's
That
one of
is,
my theorems, that the market moves to frustrate the greatest number of people.
that's a good point though, because I mean, if there are a lot of shorts, then I mean, so this was Tom, I think I was talking to you that day when we gapped down really hard on the CPI news. I was covering a lot of my shorts, right?
All
I
right,
almost
that's
I
this
actually
bar.
went wait, was it that one?
Yeah, it was a CPI
Uh
print,
no, 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 no.
wasn't
That
it?
one. No, no, it was a Green Day actually. It was 3 days ago.
On to this day.
Yep. Yep. The big wick down right there in the morning. It was
This
a
was
crazy
another
wick down.
report then. Which one was that?
That one was the Fed chairman, Jerome Powell, coming out and said there will be pain for American families and you will lose your jobs.
I thought it was a report.
No, no, he was making that statement that day. Like he had like devil look in his eyes too while he was saying it.
I'll
He's
just look up on Day while we're talking to see what was going on that day.
Yeah, I'm pretty sure that was the day that Jerome Powell, because and unfortunately, I actually had a long position on that I put on in at the beginning of September, and I was doing great on it, and then all of a sudden he opened his mouth and it blew me out, and I was like, no. So yeah, he
Uh, this was Tuesday, the 13th of September.
Rich is like, what do you have against short people? I'm 5'10. Man, no, dude, you're tall. Like
Oh, that was a
5'10,
CPI
you're
report.
solid at 5'10. Um, was it a CPI on
Yeah,
that
it
on that
was
day?
CPI was this day. Yep.
Really? Was it Jerome Powell that was? Oh, okay. Wait, it must have been the big red bar prior to that. That was
This one,
yep, that one. That one must have been Jerome Powell.
August
So yeah, it was
26th.
one of those flash moves downs. And yeah, that was a high CPI. I mean, we had another high CPI report
Oh yeah,
too.
here it is. August 26th. Powell says rate hikes
Yeah,
until
there it is.
inflation. Yep. So this was the
Yep,
J Powell. This was the CPI print.
right. And that's basically what's caused this, or I shouldn't say what's caused it, but it's what's pushed this whole sell-off down. But in general, as we've been paying attention to, macros in general, a lot of things have gotten worse, right? Rates have gone up stronger and higher. And this is something that it always depends on what the recession is built on. So, for instance, 2008 recession was built on inflated asset bubbles in mortgage-backed securities and slowing growth inside the United States. And a little bit of high inflation with rising interest rates, right? So you kind of had that mixture going into 2008 that created the '08 recession. This time it's under high inflation, rising interest rates, and an asset bubble that was created by central banks. So then it's not the slowing growth that actually was the initial problem. The slowing growth is the side effect of the tightening monetary system to, basically pop the bubble that they created in COVID. So if we kind of think like that, what's going to turn the recession around is going to be normally the same thing, unless slowing growth gets entrenched. And we're not right there. We're not in slowing growth is necessarily entrenched. It's not like everyone's going belly up and we've got businesses just collapsing everywhere and things like that. The consumer is actually surprisingly still spending money mostly on debt, but it's still there, right? So we've got that. So I kind of think through and I do these little mind games with myself all the time. Like, okay, if I were to like pay attention to something that was actually going to turn everything around, what would it be? Well, it would be inflation coming down, right? And the Fed not having to tighten as much. So, well, where are we, right? Well, inflation's still at 8.3, way, or 8.2, way higher than any of their targets. So we're not even close to that point. I don't care what anyone says. Oh yeah, Fed dove pivot or whatever. Like, no, they don't pivot at 8.2%. And then, on top of that, you've got this, and then they're also doing quantitative tightening, right? So you kind of got all of this going. And then as soon as inflation starts to come down, my concern at that moment would be that we would actually start to see a lot of capital flow out of equities and into the bond market, just like we saw in the October meltdown of 2008. You remember that one?
Mm-hmm. Yep.
That was a pretty vicious down push. I think the Fed's trying to make it a stable, calm, a stable,
A
calm
soft
deleveraging.
landing. Yeah.
Right. Which is still a soft landing is still not a comfortable one by any means. But I mean, in order to stop inflation, you really do have to have people stop spending. And the only way that you normally get people to stop spending is for them to either lose their job, or lose their job, right? Like, I mean, most people just keep spending as long as they've got, income in general. So yeah, I don't know. What do you think about that, Tom? Where are you at on that whole camp?
For inflation and spending.
Yeah. I mean, because you've gone through a few recessions, right? You've seen the .com, you've seen the '08. Um,
Here's
what
2008, by the way.
there you go. Yeah, there's the October meltdown. So, hey, can you overlay like the 20-year bond on that, or even the 10-year?
Let's see. What's that symbol? US 10Y. US 10Y.
And this is what happens at the bottom typically.
There you go.
So see how coming into September, right? Coming into September, you can see that bonds, or not in September, but the in October and everything like that, you started to see this big violent swing up and down in the 10-year yield, right? As the market melted down, right? Because that's the 10-year yield, right?
Yep. Mm-hmm.
Yeah. So when you start to see those big violent moves in the 10-year yield, you can kind of reference that to institutions, right? Because institutions, they don't just hit the buy button like a crazy man, right? They just kind of feed in, right? And so institutions were moving out of stocks. They have to sell first, and then they buy into the asset, right? So that's what they're doing. So this is the rotation that you're seeing. You're seeing stocks start to go down as the selling pressure hits. And as they sell stocks, they're buying into bonds, which is creating the volatility in the bond market. And then now that they're finished selling stocks, or most of the way through, they load into the finishing of the bonds, and then the bond yield crashes, right? So that's that capital flow that we can pick up on sometimes when you start to see two assets uh, that are the base, the main base assets of the financial markets. So it's kind of cool to watch that in real time. And so then if you fast forward all the way to today, kind of where are we in general, and you're not seeing the same thing that we're talking about yet, right? We're not seeing the bond market chop or slow down or cool off by any means, or we just got a flat line there, Tom. What happened?
I don't know. It's let me just delete it and re-add it. That was weird.
We'll take a 4% yield with no movement forever, right?
Okay, well, I think the part of the problem is the yields have gone up so much, like
Right.
500% versus the equity market, it's just dwarfing it.
Yeah, right. Yeah. So, I mean, this is when you start seeing stocks sell off, right? And then you start to see that chop in the bond market, and then maybe even you'll start to see CPI really start to drop, right? Because that once you start to see CPI start to be projected down pretty aggressively, which we're getting really close to that, by the way, you'll start to see money move out of the equity markets and into the bond market, and because there's no new money being printed right now, that's a big deal. So it's not like they're getting new money to just push into the bond market and keep their portfolios balanced. They have to sell it from somewhere first and then rotate it into the bond market. And right now, long-term rates at least are producing positive yield again, right? It's been a long time since we've had good, solid positive yield in long-term rates. So they're starting to get really attractive because um, the the earning or the yield on the S&P 500 is kind of garbage right now. I think it's only about 4%, so it's pretty equivalent to the
Pretty
yield on
close to the
bonds.
bonds. Yeah.
Right. So which one would you prefer to have? Would you rather have something yielding 4%, or would you rather have something like in equities that have the volatility of equities yielding 4%? Right.
Well, depends on your long-term outlook. I mean, the market historically does more than that.
There you
So,
go.
but
So
can you survive that moves down? Depends on
right
your
in the
investing
short
timeline.
term, right? In the short term, you still got a slowing growth economy. You still got a tightening Fed, right? So in the short term, where would you prefer to put your money if you're going to get the same amount of yield, right?
Well, probably bonds because there's still a lot of uncertainty with the equity market.
Right. And so that's every portfolio manager in the world, right? And you definitely don't want it in Europe. You don't want it in Europe bonds. So you're actually in globally, we do have an edge here because the rest of the world is doing really, really really, really bad. I mean, Europe is just a nightmare. And you sell out everywhere else, right? And so you sell off all your assets over there, and then you kind of move it into the reserve currency and the reserve currency bonds and all those types of things. Damn, we gonna go negative for the day?
I don't know. We're only up 21. We were up what, 80 something?
Yeah, it was strong. And just bear market rallies. If you give a hope for dollar to strengthen, not in relative but in absolute terms, then people will hold on to it. If there's a perception of an end game, each run up dollar is a chance to unload it for real assets, which increase velocity and push inflation, I suppose. Market, I guess that was somewhat of a bull statement, right? So he's kind of saying in general, let me kind of like paraphrase this, I think.
I think
In
that's his case
general,
for the upside.
yeah, I think he's saying that, okay, as the CPI cools off, you'd want to, you can hold on to the dollar finally, and you can save it or convert it and buy a real asset with it, such as like real estate or maybe even stocks or something like that, like some sort of asset, and it would push the prices up of those assets. Yeah, that's a pretty good little point right there. This is something I don't know if anyone really talks about this, but the generational shifts that we see even in the world and in the United States. We're coming to baby boomer retirement, right? And a very large population kind of starting to draw on their retirements. Now, it used to be based, pension fund based, but we moved away from pension funds a long time ago. So in general, baby boomers are pulling off of their retirement now. And if you have a huge amount of your population starting to sell assets such as stocks and bonds and all that to buy real assets because they need things to live off of, in a way that's very inflationary and very deflationary for asset prices, right? So that's something to kind of think about, just a little fun game right there.
Do you think
um,
they're buying more though? Is that really inflationary for the cost of goods, like, the CPI kind of stuff? I
well,
don't
I
think
don't
they're increasing
necessarily.
their spending, right?
Yeah, well, I think.
There's transitioning to a different source of funding from a job to retirement.
Yeah, I guess in general they're going from selling asset prices, which does have a selling pressure. But then I guess what you're saying is that, well, they're still buying the same amount of stuff that they've always done,
They
which
still
would
have to
mean
get
that,
eat and pay rent and all that.
yeah, but since they're not working, wouldn't they have more free time during the day? So wouldn't they travel more? Wouldn't they go out to eat more? Wouldn't they spend more on healthcare? Those types of things, because they're also aging too, right?
Well, I notice, like my parents and Gabby and I as well, we are eating out more, but there's only two of us. So,
Yeah, that's a good point.
it's like we can spend the same amount at the grocery store, go out to eat, and now we don't have to prepare it or get the groceries and all that stuff.
Spoiling the
So,
grandkids, though, none of that.
well, yeah, maybe a little, but they're kind of
Traveling
far away
more.
though. We have two,
Yeah,
there are
that's
three in Germany and one in Oregon, and we're in Colorado, so they're not close.
yeah, there you go. Yeah. Yeah, it's interesting. I mean, so on a technical basis. So by the way, let's kind of talk about the options side of things. How are people doing on the options world?
Well,
Are you
the box car, I just eked out basically a scratch on my box car. I put it on like here. Where's my mouse? Somewhere around here, and then we had boom, 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 down, 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 and it
Mhm.
was down fairly hard, like 5, 6%. But then I kept adjusting it, kept up with it, cut and rolled and all that. And then we had some rallies that kind of got it back to semi okay. And it expired yesterday. And yeah, I made like $29 for all that work. But it's fundamentally a bullish trade, kind of like the Schwab, but the Schwab doesn't do the aggressive adjustments.
Right.
Um, and Schwab is a little bit longer term too. This box car is like 10, 12, 14 days.
Yeah.
I'm looking for a down day to put another one on. I don't know if this one's going to count. I might wait till tomorrow. The zero DTE stuff is interesting. We went short today, and everybody made a profit. Um, that's kind of interesting trading because you're flat. There's no overnight risk. There's no weekend risk.
Right.
Uh, so
And
it's
you
very attractive.
Yeah. Yeah, zero DT. I know working on that. That's actually a really fun thing. I told you that I was kind of digging into that as well. Yeah,
Oh,
there's
and
a I mean, I know this last kind of cycle in the market in general gave me some challenges on the options front. So I definitely had some challenging trades over the last, I don't know, couple months.
I mean,
So
it's been pretty volatile. I mean, this is the trade that we had today, and even now we're only 2 hours after the open. The expected move, which is just the at the money straddle price, is almost
mhm.
$35. So it's pretty violent right now. You get big
Yeah, I
moves
mean,
up and down.
and in general, like even my options trades do spread out and take care of the general ranges. So I mean, like, the size of my trades are just massive now as far as like spread widths and even delta parameters and types of things if I'm using delta. But it's just it's not even necessarily the moves, because the moves have stretched out just fine to them, but it's just it's I don't know, it's slightly odd behavior. And I guess the whole thing that kind of started that was the big supposed CPI slowdown that kind of blew the market up to the oblivion. And then of course then Jerome Powell, and then bad CPI, and then another bad. Well, this bad CPI isn't a problem, but those big wicks. I would say somewhere around August, I had a trade that ended up getting stopped out to the upside, and then two trades on the way down that ended up getting stopped out to the downside. So it was quite an interesting little ride that I've had. And that's rare for me to have such a challenging time period, but I mean, or at least consecutive ones. So, if anyone's out there having a little bit of a challenge, definitely don't feel that you're alone there. Now, I've had a lot of trades that have worked out very well. Like I said, I've basically shorted every rally that's happened. And so the short side of my trades have been working out very well. But yeah, it's been
Uh,
challenging for some of my other ones.
This is causing some problems for a lot of people. Um,
Yeah, 31%. Yeah. And so here's another thing right here. Look, we have an up VIX and an up market right now. Like, this is not a good sign. I'm telling you, like, that is a big. I mean, so like this morning on the gap up, I started to short more, right? I started to short like EWG Germany. I started to short HYG. Um, I started to short tech, right? Everything's just kind of being stupid right now. So, but wait a second. Well, we got to tackle that. Come on, for options traders, high VIX is a blessing. Marcus, hey, Tom, is that always right? Is high
well,
volatility a good thing for options?
it's good if you like butterflies. I mean, it cuts both ways, right? So if the VIX
Mm-hmm.
is high, then you're getting a lot of these huge moves, which depends on what kind of strategy you're doing, can really put a lot of stress on your positions. So yeah, you do get more premium, but there's also more risk.
Yeah, Marcus, you're absolutely right in general. There is something else to kind of take a look at that too. So when I was working for the fund, one of the biggest things that we looked at was okay, sure, volatility is high, but is volatility priced accurately for what you're having to deal with on a movement basis? Exactly what you talked about, Tom. So, like, for instance, if there's a solid implied volatility premium, so for instance, the implied volatility is significantly higher than in general what you're getting out of realized volatility, then that's phenomenal for an options trader. Now, if you have it the other way around, though, if you have the VIX, very, or I should say volatility, if you have volatility very high, but the market is, let's say, trending really aggressively, right? Then that trend can really blow you out of neutral trades that are trying to sell that volatility, which means you have to start being directional. And then, so then if you're directional and selling volatility, then that's when it's a good situation. So, like, for instance, being directional and selling the volatility in high volatility with implied volatility um, premiums, or not premiums, but like, let's say, a discount in the implied volatility, that's a fantastic side. So it's just kind of how you play it in general. And right now there is a 33 VIX or so, or there has been 33 VIX or 30 VIX and things like that. But just to kind of think about, it's not necessarily the daily move unless you're trading like Tom does, which is a daily trade or an intraday day trade or just a 1 day trade. Really, what you care about is, hey, how far is the market moving over the time period in which my trades are? So, for instance, if I've got a trade that's, let's say that I've got a trade that's, I don't know, 30 days long, right? Let's say I'm going to hold this trade for 30 days. If I've got an implied volatility of, say, 33, but that is translating to a trend that's larger than what my trade can handle, then realistically that move is not being priced in accurately for my trades, right? So it's really important to kind of know what fundamentally impacts each one of your trades. So yeah, the trends on the way down this time is what caused me a little bit of trouble in my trades, right? So things like that can just, and sometimes you can foreshadow or foresee those, right? Sometimes you're like, hey, I know the market's very trendy right now, or most likely it's going to trend down. But at the same time, I had a general expectation, looking at my data series and my quantitative analysis, that most likely we were going to have a little bit more chop than just a straight trend down until later this year. And what ended up happening is we had basically the complete opposite. We had basically the Fed going, no, screw all of you guys. We're going to crash this thing now. And that really did kind of switch everything. And then once interest rates did what they did, then it was kind of like, oh, well, that's what's going on now. And so then we can switch accordingly. But it means that some of my trades were a little bit caught off guard. So I just, kind of things to say that we've got a lot of action in the comment box now. So
Yeah,
what
so-called
happened
neutral
here?
trades are not for this market. Unless you go super wide, you can probably still make it work. But it's definitely like the old iron, buy an iron a condor, and hopefully that's going to work. That's going to be challenging, especially
Yeah, I
with
mean,
these kind of moves. I mean, you're just going to get blown out right away.
well, I mean, in general, though, this is a fantastic time to trade options. It really is.
I mean,
Honestly, there's
traders
always a,
want movement generally.
yeah, I mean, in general, right? Especially if you're directional, you're really having a great time right now, which is exactly what I've been doing. But you, like my short trades and my shorter term options trades have been doing phenomenal. Um, I mean, literally over the last couple of weeks, I think I'm up like 30% just in that account. So, but that's a very different mentality than someone that's just simply selling only volatility or only selling time premium. So if you're kind of quote unquote market neutral, that's what sometimes people get caught off guard, is that you're sitting there saying, hey, or we can sometimes say high volatility is a good time for options trading. And well, it still depends on what kind of an options trader you are. Are you a swing options trader, or are you a market neutral options trader? Because if you're a swing options trader, then high volatility, high movement is beautiful. Absolutely. Right. So run those types of strategies. If you're more of a neutral trader or someone like that, then you've got to watch out for that too.
And Thomas has a
Um,
point. If you're directional, and futures are pretty good leverage,
oh
and you
yeah,
don't
yeah,
have to
there you
worry
go.
about Greeks too. And
Yeah,
it
yeah.
looks
I
like
mean,
we're
and
like 50 or at the lows for the day, by the way. We're painting a red bar.
there you go. VIX is still spiking, but we're still up supposedly. So yeah, it's just kind of how that goes. We have these. I mean, I think sometimes I get emails, and I think it's great because we start to get this like, oh my god, this is, look at this big giant move, and it's like, but if you zoom out, that's not a big move. Like that's just today. Like that's just normal,
That's
right?
normal market fluctuation. Yeah.
Absolutely. Now, I will say that when the CPI came out, we had what, a 6% intraday move or 6.5% intraday move. I was like, that was a big move, even for 30 VIX. Like that was a big move. That was
Yeah. Let's see, 41.75 down to 39.50. Yeah, that's huge.
yeah, those are some monster moves. Now, what starts to happen in higher volatility too is your tails get a little bit fatter. If you're looking at like a probability distribution. So something to kind of keep in mind that happens in higher volatility is that your tails get a little bit fatter. Um, let's see what else we have here. So selling premium on 2 weeks tenor will cover most recent swings. Yep, exactly. Yep, shorter term options. Yep. Um, I stopped doing really short term ATM neutral trades because I was getting whipsawed into losses every day. Yeah, Rich. So yeah, that can maybe use something like a daily ATR swing, or like what Tom uses. Tom uses an expected move or something like that, and make sure that you're not grabbing. Um, so just to kind of see if I can help you out just a little bit on that, because I've ran into that problem much earlier in my career, where I wasn't kind of thinking about, okay, here I want to sell all this premium that's in the market, or I want to sell all this volatility or whatever. and I wasn't taking into consideration the daily moves. So sometimes if we can be patient and wait for the expected move to get pretty close to the expected move, and then sell the premium in the contra direction, and then kind of range the day. Those can actually work very, very well. So like, we're here near the low ends of the day. We gapped up really aggressively this morning. So typically markets don't like gaps. They like to fill them. So that's what we did today. Normally they don't fill them in one day unless you're in a very bearish market, which we
It
are.
looks like
So
we
there
filled
you
it.
go. Yeah, congratulations. And we also filled the previous gap. That was the little island gap back
This one
there. Yep. And so
this
now
one.
that we've filled those gaps, now the market has basically its permission to go back down if it wants to. And then also you can kind of look at it on the shorter term, which is we filled the gap up today. So now it has permission to go up. So in general, we like to fill our gaps. We have a gap that's opened up there at what, 4040, that never got
40.
filled.
Oh, this one. Is that a
Yeah.
gap?
Yeah, that little gap and run.
Yeah, that's a tiny gap there.
Oh, no,
So
no. To the red day, the next day over from that one.
This one? Oh,
Yeah.
this gap.
Yep. So in general, those gaps do like to get filled, but so we'll see if we end up getting filled.
It might take a while for that one.
Yeah, yeah. They don't always get filled, but yeah, that was the CPI announcement. So sometimes those can be a gap and runs. Yeah,
This
Tom,
one
you
didn't
use an
either.
expected move intraday, right?
Yeah. Yeah, this is the day
And
trading spreadsheet I'm using. So I just take the at the money straddle. For instance, would be a typical spread that we would do. Just sell a credit spread for 50, 60 cents, something like that. And then this is the current price, and this is the lower and upper range of the expected move. So you can see where the market is expecting to go. And we like to keep this whole thing above the short strike, or away from the short strike, basically.
your goal is to just expire it worthless. Is that the deal?
No, we try and close it out with like 10 or 15 cents. If you
Just
wait
to take
till
the risk off the table.
yeah, I mean, like the one that I sold this morning, it's trading for a nickel, but it's never going to trade for zero. So if you
Yeah.
want to expire it, you got to, wait it out. And the market doesn't close for another, what, 4.5, 4 hours and 15 minutes. So you got 4 hours and 15 minutes of risk for the market to have an amazing reversal and screw you.
So
Or you can just close it for a nickel or a dime.
and something to think about this too. So, being around the block and trading many different types of option strategies, just like you, Tom, this environment that we're in right now, and I should just say just the one parameter of this environment, which is volatility, extremely elevated volatility and sustained elevated volatility is nice to sell one day to options expirations. Could you imagine trying to sell one day options expiration when the VIX was at like 6 in 2017? How would that work out, right?
Yeah, I mean, you'd have to adjust what you're doing, maybe use butterflies or condors or something, but um, it would definitely be a different kind of trading.
So that's something to keep in mind, especially if any of you guys are, maybe newer to options or um, aren't familiar with kind of environmentally setting up your trades. Different structures work in different times. And just like what you said, Tom, that's exactly right. When you go down into, low volatility or something, you have to kind of change your structure because a vertical at the edge of the expected daily range just doesn't have the premium in it anymore. Right. So it's not worth your commissions, or the edge is so small that it's like, I'm putting on so much risk if volatility expands or something like that. So then you've got to be a little bit more selective and only do those trades in volatility spikes within that lower volatility regime or something like that. So you got to kind of change up your approach. So that way you can maintain your edge a little bit. Now, right now, you can probably throw them on every day and just have a good time. But that's something to think about. And so, maybe before we get to a low volatility regime, that'll probably happen like late next year or something like that. Or I should say lower volatility regime. You can start to kind of plan out, okay, what kinds of structures would I use on that? You can go back test, say something like 2017. That's probably too low, but probably go to like, maybe flash crash 2010 or something like that. before the
Well,
crash.
and then the delta is kind of a function of volatility. So delta includes volatility in time to me. So it kind of self-adjusts itself to this stuff. So we're generally selling about a 10, 12, 15 delta. So you're getting about the same probabilities, but with the volatilities up, that's farther away. So, you're going to get probably more premium and then about the same percentage chance of it working, but you're farther away from the market, but the market moves more. As
Hmm.
volatility shrinks, this expected move range is going to be much smaller, and your same delta is going to be a lot closer, but the market's not moving as much. So, you
Right.
know, so if you use delta as a guideline for your entry, it'll be fairly consistent over the same time periods. And then as the volatility changes, the delta will self-adjust itself.
There you go.
So that's
Now, do you take into consideration? So, just to kind of help out a little bit here, or not even help out, but just bring up something that I had to adjust to quite a few years back, which was I was using Delta in a lot of my trades. And something that I didn't take into consideration was a Greek called speed. And so the for instance, Delta in let's just take a different asset such as the NDX, right?
I
Um,
don't even think I have that on here. Let's see.
so so the NDX is bigger than the S&P 500, right?
Right.
Um, one delta, because it's a per point based, right? One delta in the SPX versus one delta in the NDX is very different, right? Because it's so much of a bigger asset, right?
Yeah, it's what, like 4 times the price roughly.
Right, exactly. So when I was using delta for my trades and we went into a higher volatility regime, from a regularly declining volatility where it kind of masked the issue, um, of delta as the asset price got higher. When the asset price moves, that delta does affect things. So that little Greek called speed can really change, maybe sometimes even where your options are, or at least in spread land, right? If you're using a spread and you're attempting to create a delta per se, it's really important to know that that delta is significantly different in a different environment and a different asset price. So just to kind of keep that in mind, if you're trading a trade that's based on deltas, to pay attention to, is it changing, right? So there's a lot of trades that were made popular many years ago and used static deltas like 50 delta, or static you know spread sizes and things like that, and that can really cause havoc when you get a very large environmental shift. So yeah, just kind of keep that in mind in general. A fun thing that I always like to do is just go over to a different asset or something like that that's a significantly bigger size and try to put your trade on. And if it starts to look odd to you, right? Like, oh my God, this structure isn't even right, or this structure doesn't even look like the structure I was trying to build, it probably means that there's a couple of your parameters that you're using that aren't dynamicized properly. And I know that I guess I'm kind of coined that word.
Dynamicize.
Did
I
you
like
put that
that
in the
word.
glossary yet?
Yeah, we should add that to the Merriam-Webster dictionary.
Yeah. So um, I know with my options trades that I have over at e-trading is they're, I spread out things, and Tom, I know you're really good at that now too. And it's just one of those things to keep in mind. So any of you guys that haven't ever heard of that or something like that, definitely dig into that and make sure that your options trades are changing with the current market conditions.
Marcus said he put on a Billy Baru. I actually did a presentation. It was on the Razzle Dazzle. Billy Baru, I think, is the next one. Let me check. Let's see if you go to options 101 calendar. Yeah, Billy Baru is what I'm doing. Not this Thursday, but a week from Thursday. I don't know. It's
And
not
that's
Thursday.
with that
I
risk
moved it to
reversal, Tom.
I moved it to Tuesday because Thursday we're going to be in Chicago having pizza and enjoying museums and stuff.
Hmm.
What about the risk reversal?
No, I was thinking the Billy Baru was like a risk reversal. I haven't heard of a Billy Baru. What is that?
Um,
Just
I have to
real
go
quick
look at
spark
it.
note.
Yeah, I have to. I'm not really. It's been a long time since I looked at it, so I got to
Yeah.
go find Scott's teaching on it and then kind of refresh myself. The razzle dazzle is basically a diagonal spread using verticals instead of singles.
Okay.
Kind of interesting. And then the dragonfly is just an asymmetric butterfly. Day trading with options. It's kind of the Scott's the stuff he looks at. We're and the zero DTE thing we're doing now. It's more what like Axe options and other people are doing, where you're just selling a credit spread. But I may start adding some trades from toss indicators. Have this volatility box thing, and here's what it looks like. I signed up this weekend is to take a look at it, but basically what they're doing is they're data scientists and quants, and they rerun all their numbers every weekend and send you updated toss indicators, but it creates these zones essentially based on the latest volatility numbers. And once you get down into this cyan area below that, into this volatility area, then you're looking for a long signal to kind of fade the opposite direction. But like here, it went too far. So they're saying unpredictable volatility. So focus on another market. But I may be using this to help with some direction stuff. It looks pretty good, pretty interesting, and maybe even useful for swing trades, like a box car. Just have to play around with it. One of the reasons I signed up for them is if you are one of their subscribers, then you have access to all their indicators and back testers and all that stuff. So I figure for 170 bucks, it's like buying all these indicators and back testers and scans and stuff. So I'll take a look at this thing to see if it's helpful. It looks like it is intraday and also possibly for swing stuff, but
Hmm.
it's interesting anyway. It's very well thought out. Let's see. Some more comments. Sweep trading a week. Strangle is very profitable. Only staying for adjustments. Okay. And I know Thomas does pretty well with his trading. I think gets a lot of theta. Oh, what do we got here? Option view. Let me go back to where is it? Oh, I was on this. There we go. Now we're back. 1 week, 100 points average. Nice. I know I spoke to Thomas. He's very intense. He spends a lot of time with the screens trading and has really good results to show for it. So yeah, so I guess looks like we're trying to rally a little bit off the bottom, but it's still kind of a negative day. Oh, I mean, we're up, but it's not very encouraging to see that kind of move up and then it pulls back and gives up almost everything. We're 60 points off the high.
Yeah, there's I was actually just looking at that, kind of looking at in general, like, hey, when have we seen days like this? And I think that there was one, at least on the Dow, but if you kind of look at where you kind of get a gap up and then you sell off through it, like you just make a big giant red candle on like the SPX. Here, hold on, I'll find the day in just a second here. I guess one of the closest ones that I kind of found was like 718. It's not perfect. Um,
Yeah, I was looking at this. I mean,
718. That one,
oh, that's
dude,
June
that one's a very, very solid down day. But I
here,
mean, it's actually starting the rally on that day on the 718.
right?
Yeah, where it
Two
gaps up,
bars off the
sells off.
low, and then it gaps up. Hmm.
Right. You kind of hit the upper range. I mean, if you look at the Russell, you pretty much tagged the upper range on the Russell and then now are coming down off of it. And then if you look at the Dow, you're actually having a breakout.
Yeah.
So a breakout and a retag, right?
So that's how markets are, right? People have an opinion to go up, down, and sideways, and it
Right.
depends on
Well,
what
then
market you're looking at.
you can kind of think about this in general. Well, what makes up each one of these indices, right? And then I guess if we can look at NDX.
I should add that. Um,
Can't believe you don't have NDX on there, Tom. What?
no, I never look at it. I can add it though.
So then the NDX is pretty weak, in regards to the rest of these indexes. We'll get there.
I gotta move it up here. It's
Yeah,
not
yeah, I
like
see it.
scrolling up there. All right, it's delayed. I guess the other ones aren't, but
Right. So, coming up trying to fill that gap, but it's not even close to breaking out, right? It's not even at its upper end of its range. So you've got risk assets that are basically in the index and the Russell. The SPX is your blue chip, so that's kind of like your general everything. And then the Dow is the largest and safest industrials, right? The pretty much the safest stocks. So the safest stocks are doing better and the riskiest stocks are doing worse. So in general, what's the if you could think of general portfolio managers or like the general machine that is the market, what is it doing? It's rotating risk from risky assets to more stable assets inside of equities. So, and then bonds are coming down today. So they're selling bonds and pushing into equities, but it still can't keep it up. Right. So there's still a general selling there. And what's the dollar doing today? Probably up, I would assume.
dollar
Yep.
is up a little bit, but it was down harder yesterday.
Yeah, yeah. So so you're just having this rotation right now. And I don't know if I would necessarily say that this is like, oh yeah, this is what makes a rally, right? If you really want to say something makes a rally, typically you'll see the risk on assets start to outperform the safety assets. So you'll start to see the Dow lag like if you go to last year, right? Like go to 2021 when there's a lot of risk on behavior,
For
and
which
you can look
symbol?
at like, yeah, you can go to the NDX. That's fine. Let's go to the NDX and let's just grab a random spot or like a random rally spot in
Okay,
2021.
here,
Let's go to like March.
March. All
Sure. So
right.
you can see here. Yeah, perfect little zoom in spot. So here, let's pick on this little April rally that falls back, tags, and then rallies strong into June. So you can kind of see this pattern here, and that's a very let's see if it's a risk on behavior, and let's go look at the Dow in that same time period. So March
I
to
don't know if it's
May, you can
gonna
probably
change
put
it
it
or not.
on. Yeah, that's fine. Is that the same time period? Yeah, there. NDX. Let's throw them over each other. Watch, I
You
picked
want
like the
more like
worst example.
SPX or?
No, no, yeah, you can throw the SPX on there too. Why not?
All right, so there
Or
we
you,
go. Do you want
so
another one?
no, no, no. This is fine actually. Um, so let's see here. Yeah, this is a really bad example actually because the Nasdaq actually had a really hard time. Um, you can see. Okay, here, perfect. Actually, no. Let's look at the time period of May to July, right? And if we look at May to July, you can see that the NASDAQ is aggressively moving straight up with no pullbacks. But you can sit there and see June 16th or 18th, that the safety indexes, such as like the Dow and maybe the S&P, are actually pulling back. It's June, so a little bit over to the left.
Like here.
Right there.
Yeah.
Yep. So you can see the pullback in the main indexes. So if you're sitting there going, hey, look, we have a pullback in the Dow, a small pullback in the S&P, and basically no pullback whatsoever in the NDX. That's like, oh no, there's solid risk on right now. That's a rotation into risk on assets, right? And that's a very bullish sign within that pullback in those larger assets, right? So most likely it's not going to turn into anything major, is normally how I would kind of translate that. And so if you see what's kind of going on today, which is the NDX isn't keeping up with the Dow or the S&P to the upside, it's kind of the same thing in opposition, right? The risk off is still risking off towards like tech and riskier assets.
Right.
Sweet.
All right. Well, we're at an hour, so I don't like to go over unless we have something super interesting going on. This is a great discussion, though, but I also have to get ready for my boxcar meeting, so that's in a half an hour. So Wayne, thanks for having somebody to bounce ideas off with. It's always better than just trying to come up with stuff by yourself. So appreciate that.
Absolutely.
And
Always fun.
glad the portfolios, asleep well and awake, are doing fine. You know what, the equities are down over 20%, and you're down just a couple, just off the high. So that's really, really nice. And I don't really have any other announcements. Yeah, I mean, we made money in the zero DTE stuff today. I also added a trade guidelines to it. It's a kind of a work in progress, just one page, but I started that, and I think that's about it. So why don't we wrap it up, and we will see everybody next time. All right. Thanks, Wayne.